Welcome to Pro News Weekly. Let's dive into the latest updates on the financial markets. The US dollar is preparing a new attack. Stock indices have recovered from the shock. Gold is looking up, and Bitcoin is delaying its surrender. While the market tries to figure out tariffs, Euro-USD is rising, supported by US stock indices and improved global trade. According to HSBC, supply chains have been restructured, with a sharp increase in turnover in Asia. At the same time, trade in services, which is not affected by import duties, is growing faster than trade in goods. This dynamic supports the Eurozone's export-oriented economy and contributes to the strengthening of the euro. According to 57% of Bloomberg experts, Christine Lagarde will leave her post as head of the ECB earlier than expected. Klaus Knot appears to be the leading candidate to replace her. As a hawk, he increases the likelihood of a deposit rate hike in 2027. The futures market expects the federal funds rate to decline next year. Divergence in monetary policy will be a powerful driver of the euro's rally in the medium to long term. The rise in U.S. stock indices is putting pressure on the dollar as a safe haven currency. At the same time, hawkish rhetoric from FOMC officials and a decline in the probability of the Fed easing monetary policy in June to 46% are holding back the bulls' offensive on Euro-USD. U.S. stock indices went on a roller coaster ride. For weeks, the S&P 500 and NASDAQ Composite were pressured by rumors that artificial intelligence could cause significant disruptions across many businesses, ultimately weighing on the market. However, they quickly bounced back thanks to upbeat corporate reporting from NVIDIA. The world's most capitalized company's revenue exceeded forecasts, and profits rose 94% compared with the first quarter. Interest in tech giants has really picked up again. Investors are being convinced that AI is an assistant, not a competitor. On the contrary, small-cap companies that felt confident at the beginning of the year found themselves in a vulnerable position. The U.S. economy slowed to 1.4% in the fourth quarter, and the Fed's rate cuts were postponed from June to July, putting pressure on the Dow Jones and Russell 2000 indices. On the other hand, Bloomberg experts' forecasts suggest that European indices have neared their peak, which could reverse capital flows from east to west. Geopolitical tensions in the Middle East and tariff uncertainty are pushing gold prices higher. The failure of negotiations between the U.S. and Iran will lead to armed conflict and increased demand for safe haven assets. Meanwhile, Donald Trump has opened Pandora's box with his new 150-day tariffs. As a result, investor interest in debasement trading will return. J.P. Morgan forecasts gold to rise to $6,300 per ounce by the end of the year, driven by strong demand from central banks and investors. This would amount to about 585 tons per quarter. Investment service MKS PAMP has studied 5 bull markets over the past 50 years and believes the current rally in precious metals is only midway through the cycle and could peak at $6,750. The factors holding gold back are the lower chances of the Fed resuming its rate cut cycle in June, along with the associated strengthening of the US dollar and rise in treasury yields. Trust in Bitcoin has taken a hit, although some argue this is consolidation rather than capitulation. Yet the data tells a more resilient story. Around 9 million tokens, roughly 45% of the circulating supply, were bought below current levels. In fact, 55% of holders are still in profit. BTC bulls are not throwing in the towel. They are using every opportunity to push back. Gains in U.S. stock indices recently helped trigger a fresh crypto rally. Bitcoin's near 50% drop from its October highs was partly driven by ETF outflows. But those outflows represent just 6% of the total capital that has entered crypto ETFs since their launch in January 2024. Most investors have kept their capital in place. Major buyers, including Michael Saylor's strategy, continue accumulating on dips. So where is the capitulation? For now, crypto enthusiasts are still very much in the fight. As Donald Trump's 10 to 15-day ultimatum to Tehran expires, the risk of armed conflict will rise. The U.S. is building up its military presence in the Middle East, while Iran is accelerating arms purchases from China. Both sides are preparing for war. If it breaks out, investors' attention will be focused entirely on geopolitics. Most likely, safe haven currencies and those of oil-exporting countries will benefit. In a shock scenario, Brent crude could jump above $90 per barrel. If the conflict is resolved diplomatically and carnage is avoided, the main event of the first week of March will be the U.S. labor market report for February. January's employment statistics convinced Fed officials that the situation is stabilizing. Even Christopher Waller, who voted for a rate cut in January, is ready to join the majority and keep rates unchanged until the summer, provided there are no unpleasant surprises in the employment data. In this scenario, the primary beneficiary will be the U.S. dollar. Investors will be watching for data releases on European inflation, U.S. retail sales and business activity, as well as developments surrounding the White House's new tariffs. Stay up to date with global markets and Pro News Weekly. Like, share, and subscribe.